Let's jump right into this explainer. You've probably seen the massive, scary headlines about U.S. household debt hitting staggering new records. But today, we're going to cut through all that noise and break down exactly what's actually happening to consumer finances. What does this astronomical number really mean for the broader economy? And, more importantly, what does it mean for your own wallet? Let's get right into it. Now, before we really get going, just a quick reminder, this explainer is strictly for educational purposes. Things change incredibly fast in the economy, so this isn't financial advice. Always consult a licensed financial professional before you make any major money moves. Okay, let's dive in. So to really wrap our heads around this, let's look at a real-world example. Meet David. He's 44 years old, he's got a $380,000 mortgage, but he's locked in at a beautiful 3.1% interest rate. Lucky guy, right? But he also has a $28,000 auto loan at 7.2%. He's got $8,400 sitting on his credit cards at a pretty painful 21% APR, and $34,000 in student loans. If you add all that up, David owes $450,400 across four very different types of debt. Now look, David isn't in a full-blown crisis. He makes his minimum payments, but every single month he watches a massive chunk of his take-home pay just evaporate to service these balances, rather than building up an emergency fund or saving for retirement. But what happens when we zoom out? When you multiply David's exact situation by 130 million American households? Well, you arrive at a truly jaw-dropping record, $18.8 trillion. That's the official figure the Federal Reserve Bank of New York just reported for U.S. household debt in the first quarter of 2026. It is a literally massive number, and honestly, it's got a lot of commentators out there predicting total economic doom. But the reality is actually a lot more nuanced than that. To put this into a slightly terrifying perspective, let's rewind a bit. Back at the absolute height of the 2008 housing bubble, total household debt was $12.7 trillion. Today, we're at $18.8 trillion, meaning we just blew past the 2008 record by nearly $6 trillion. That's a massive 32.9% increase in just 5 years if we compare it to the end of 2019. Now, seeing those numbers side by side, yeah, it's really easy to panic. But we really need to look closer at what actually makes up that $18.8 trillion today compared to back in 2008. If we crack open this giant macroeconomic headline, like a Russian nesting doll, we actually get a much clearer picture. Because an overwhelming 70% of this total debt is actually just stable mortgage debt. Generally speaking, that's considered good debt since it builds equity, and right now, mortgage delinquency is extraordinarily low, sitting at just 1%. So the real danger? It's not that massive stable chunk of mortgage debt. The real danger is hiding in the smallest slices of the pie: auto loans, student loans, and credit cards. Which brings us to a quote that brilliantly illustrates our core theme for today. The distress signal is inverted. The smallest categories have the highest default rates. So what does this actually mean? Well, it means it isn't the giant $18.8 trillion number that should keep you up at night. Rather, it's the intense, acute stress concentrated inside those really small debt categories. That's the crucial insight most news headlines are completely missing. We aren't facing one giant crisis. We're facing a series of smaller, highly acute crises happening all at exactly the same time. So, let's peel back the layers on these four hidden crises, starting with Crisis 1, the rate lock divide. Basically, America's housing market is completely split in two right now. On one hand, you have pandemic-era buyers. They're sitting pretty comfortably on low, sub-4% interest rates. They aren't selling, they certainly aren't defaulting, and their fixed monthly payments are actually becoming a smaller percentage of their income as their wages slowly grow. But on the flip side, you have a really stretched minority of new buyers. These folks are paying absolute peak home prices while also taking on 6 to 7% interest rates. So while overall mortgage delinquency is super low, the financial stress is almost entirely concentrated on this specific, highly stretched group of recent buyers. Moving right along to our second danger zone, we find Crisis 2, the auto debt squeeze. Auto loan delinquencies have alarmingly spiked right back up to global financial crisis levels. And here is exactly why. $48,841. That is the average price of a car right now. Let that sink in. When you combine prices that high with 7 to 8% interest rates, and then you stretch those payments out over 72 to 84 months just to make the monthly payment feel somewhat affordable, you create an absolute trap.
So many borrowers are immediately underwater on their vehicles. They owe way more than the car is actually worth from day one. If they lose a job or get hit with an unexpected expense, they can't even sell the car without having to bring cash to the table.
Next up is Crisis 3, the credit card spiral. This right here is where the affordability crisis hits the absolute hardest. A staggering 13% of credit card balances are now delinquent. To put that into real dollars, there is over $160 billion in credit card debt that is seriously past due. And look, this isn't cheap debt. It is snowballing at a punishing average APR of 21%. When your paycheck runs short because of inflation, credit cards become the ultimate last resort. And for a really meaningful chunk of households right now, that last resort is completely maxed out and they are falling behind.
Which brings us to the final and honestly most acute stress point. Crisis 4, the student loan cascade.
Right now, we're watching a massive default wave that's nearing pre-pandemic levels. Get this, 3.6 million borrowers defaulted on their student loans in just 2 quarters. But here's the really scary part. Student loan default is rarely contained. It's like a domino effect. When millions of people default here, it creates a vicious cascade that drags down their other bills too. Nearly 40% of people who default on student loans also fall behind on their auto loans, and an incredible 56% fall behind on their credit cards. It just completely destabilizes the entire household balance sheet.
Now, normally, when consumers are under this much financial stress, the Federal Reserve might swoop in and cut interest rates to offer some much-needed relief. But because inflation is proving incredibly stubborn to contain, the Fed is trapped in a higher-for-longer policy, meaning they literally cannot cut interest rates to rescue struggling consumers without risking another massive spike in inflation. So, if you're sitting on 21% credit card debt or an 8% auto loan, no one is coming to rescue you with lower rates this year.
And this macroeconomic standoff, it ripples directly into your daily life. Because when delinquency rises, banks get spooked. They trigger tighter lending standards, essentially shutting out borderline borrowers completely. Meanwhile, those high rates mean your minimum payments are eating up a much larger chunk of your take-home pay, leaving you with way less money for food, rent, or savings. This sparks a widespread slowdown in consumer spending. And remember, consumer spending drives 70% of the US GDP. Combine all of this with cascading credit score damage, and the economic slowdown just starts feeding on itself.
All right, understanding these 4 macro crises is fascinating, for sure, but it's only really useful if it actually changes your strategy. So let's zoom all the way into your personal playbook. Let's start with your mortgage strategy. If you're lucky enough to hold low-rate mortgage debt right now, you are literally in the best possible position. Your strategy is incredibly simple. Stay put. Keep your low fixed rate. Let that predictable payment do the heavy lifting for you. Absolutely do not voluntarily refinance, and whatever you do, do not tap your home equity to fund your daily lifestyle while rates are this high. For your auto debt, the very first step is to check if you're underwater. Do you owe more than the car's worth? If you don't, great. Just keep making your payments and ride it out. But actually, if you are underwater and you're struggling to keep up, it is absolutely critical that you talk to your lender immediately. Do this before you miss a payment. Missing an auto payment triggers a negative credit cascade way faster than most people realize. Now, if you have credit card debt, listen up, because this has to be your absolute highest priority. Carrying a balance at 21% is a literal financial emergency. And since the Fed isn't going to cut rates for you, you have to aggressively take matters into your own hands. Call your issuer. Try to negotiate a hardship rate reduction. Look into transferring your balance to a 0% intro APR card, or even contact a nonprofit credit counselor at nfcc.org. Every single month you delay here is costing you real, hard-earned money. Finally, for student loans, your strategy comes down to proactive management. Log into studentaid.gov today, right now. Ensure you are actually on the correct income-driven repayment plan. The rules around this have changed recently, so you really need to make sure your specific plan matches your current income level before you ever get close to that highly dangerous 30-day default window. Which brings us to the ultimate rule for your finances right now. Because the macro distress signal is inverted, your personal playbook has to be inverted too. Ignore that massive, stable mortgage balance and fiercely attack your highest rate consumer debt. It's all about targeting the smallest balances with the highest interest rates first. That right there, that is the difference between having a rock-solid plan and falling into financial panic. Well, we've covered a ton of ground today, and now I would love to hear from you. Which type of debt is your biggest financial stress right now? Is it your mortgage, the auto loan, those credit cards, or the student loans? Drop a comment below and let us know. And hey, please make sure to hit that like button, share this with a friend, and subscribe to the channel so you don't miss our next explainer, where we're going to continue breaking down the economic forces shaping your world. Stay smart with your money, and I'll catch you next time.